Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at PepsiCo.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, let's unpack this one because PepsiCo has been, well, a real beacon of resilience, hasn't it? Even with this consumer slowdown we're seeing everywhere.
It really has. Their last quarter was quite robust.
I mean, the numbers were strong. EPS came in at what, $2.29? Beat the street. And revenue was nearly $24 billion.
Up about 2.7% year over year. It was a classic case of a company using its pricing power to keep the top line growing, even when volumes were a bit soft.
Right. But that's the past. The market is all about the future, and the guidance seems a bit cautious.
That's the key point, that resilience is sort of baked in now. The focus has shifted, and 2025 is being framed as a necessary reset year.
A reset year.
Exactly. Management has been careful here. They've guided for core constant currency EPS in 2025 to be flat.
Flat, so zero growth. That sounds, well, a little alarming for a name like PepsiCo. If the immediate forecast is so tepid, why are we even talking about it now?
Because that muted outlook is happening for a reason. They're investing heavily in the turnaround right now, absorbing costs to, simplify the business.
Spending money to save money later.
Precisely. But the real story here, the deep analysis, is the setup for the years after that. The acceleration they're guiding for in 2026 and 2027 is very clear.
Okay, so what are those key numbers? What does this acceleration actually look like on paper?
The 2026 targets are very specific, and they really are the anchor for this whole thesis. They're targeting organic revenue growth of between 2 and 4%.
Okay, that's solid.
But the crucial part is the earnings. Core EPS is expected to jump, growing 5 to 7%.
And that's a big jump from flat.
A huge jump. And it's all built on one major internal goal: achieving approximately 100 basis points of margin expansion over the next 3 years.
A full 1%. That's the engine right there.
That is the engine. And just to clarify on the revenue piece.
Wait, because I heard the reported number might actually look even better than that 4%.
That's right. When you factor in some of the acquisitions and divestitures they're doing in 2025, their reported revenue growth for 2026 should actually land in the 4 to 6% range.
So 2025 is the trough, and 2026 is when the plan starts to really pay off.
That's the idea. They absorb the pain in 25, and the momentum starts to show in 26.
Okay, so what's been causing this need for a reset in the first place? Because the growth feels like it's been pretty uneven across the portfolio.
It has been. And the whole narrative really is centered on fixing one particular segment.
Which is?
PepsiCo Foods North America.
Uh-huh.
That's both Frito-Lay and Quaker. That division has been the main drag on performance.
So it's a North America problem.
Mostly, yes. The international segments and the beverage business have actually held up pretty well. This is really a fixed North America story while leaning on the rest of the world as a buffer.
So why are Frito-Lay and Quaker struggling? Are consumers just pushing back on the price hikes there more than anywhere else?
Exactly, you've hit it. The lower and middle income consumers, who are, the heavy users of those everyday snacks, they've been hit hardest by inflation.
And they're trading down.
They're trading down or just cutting back. So when PepsiCo pushed price to cover their own costs, they lost volume. And now they know they have to get that volume back to really leverage their fixed costs.
So how do they do it? I know they're talking a lot about cutting complexity, which sounds easy, but must be incredibly hard for a company that big.
It's the hardest part. They are aggressively, and I mean aggressively, simplifying. Management is targeting a reduction of nearly 20% of their U.S. SKUs.
20%. That's on top of cuts they've already made, right?
It is. They had already taken out about 15% before this, so this is a massive undertaking.
But how does taking Doritos flavors off the shelf translate into that 100 basis points of margin?
Well, the savings compound. First, you have less inventory and waste. Second, your manufacturing lines run better. Fewer product changes means more uptime.
And logistics must get way simpler.
Massively. It is so much cheaper to ship truckloads of 50 products than small pallets of 500 products. It just lowers operating costs across the entire system.
That makes a lot of sense from a cost perspective. But what about the other side? How do you get the volume to actually recover?
That's the other half of the plan. It's a pivot in pricing strategy. They're moving away from just price-led growth and shifting to what they're calling sharper everyday value.
So more promotions.
Targeted promotions. They're testing specific price investments with their 3 biggest U.S. customers. It's not about cross-the-board discounts. It's about making key products affordable again to drive those unit sales back up.
That shift is huge, from price to volume. What makes PepsiCo better positioned to pull this off than its competitors?
It comes down to their moat. It's really threefold: scale, their route to market, and just immense brand equity.
I mean, the brands are iconic. Pepsi, Gatorade, Lay's, Doritos.
Cheetos, Quakers. That brand diversity is key. It makes them resilient.
And that diversity is what really separates them from a pure-play rival like Coca-Cola. It's not just that they sell both chips and soda.
No, it's the combination. The
Yeah.
strategic power of having both salty snacks and beverages is something their rivals just can't copy.
The share of stomach idea.
Exactly.
Right.
Think about a convenience store. They can cross-merchandise chips with sodas, Gatorade with snacks. That power lets them negotiate for better shelf space, better placement. It's a massive structural advantage.
A very powerful defense. Okay, let's look at the foundation for all this. Does the company have the financial health to pull off this turnaround while still rewarding shareholders?
Oh, absolutely. The foundation is rock solid. It's an investment-grade balance sheet. Yes, they have debt, but it's very manageable for a company that generates this much cash.
And that cash flow is what supports the shareholder returns, which are, well, pretty attractive right now.
Highly attractive. The dividend is $5.69 a share annually, which is a yield of about 3.8%. That puts them firmly in the income camp.
And what's reassuring is how clear they are about where the savings from all this simplification are going.
It's a balanced approach. The savings from the ski cuts aren't just dropping to the bottom line tomorrow. They're using it to fund three things: more advertising, those consumer value investments, and finally, that margin enhancement goal.
So they're cutting costs to invest in growth. Makes sense. Let's talk about the market's reaction. If the 2026 story is so clear, why isn't the stock taking off?
Well, the sentiment is cautiously constructive. The street is basically in show me, don't tell me mode.
Waiting for proof.
Exactly. The pullback in the share price was all about those North American volume concerns. So this consolidation period has created what a lot of people see as an accumulation base.
But the smart money, the institutional money, seems to be moving already. That's usually a pretty good signal.
It's a major confirming signal. The institutional accumulation has been significant. You see inflows from some very sharp money.
Any names that stand out?
Halcyon Advisors, LP. They increased their position by an incredible 2,437%.
Wow. That's not a small bet.
That is a high conviction bet on the turnaround plan. And you see others, like Murex Group and Headlands Technologies, also add in significant positions. The big money is moving in while the market is still waiting.
And technically, does the chart support that idea? Does it look like an attractive risk-reward setup?
It does. You have some resistance around that mid-150s level, but the stock finds good support at lower levels, right, where that dividend yield starts to approach a very attractive 4%. For a long-term income investor, it looks compelling.
Okay, we've covered the opportunity, but let's talk risks. There's a regulatory issue that's been in the news, right, about their pricing.
That's right. The company is facing allegations about potential price discrimination. The idea that they might be giving better deals to massive retailers like a Walmart than they do to smaller chains.
And that could lead to fines.
It could. It's drawn scrutiny. But you have to weigh that risk. It's likely already factored into the valuation. And more importantly, as they shift their strategy away from pure pricing power, that future regulatory risk should actually go down.
Okay, so a manageable risk. What about the big one, the execution risk? What if the plan to get volumes back just doesn't work?
That is the pivotal uncertainty, for sure. But the downside here is cushioned by a really significant external factor,
Which is?
the presence of an activist investor.
Yeah.
Elliott Investment Management.
Ah, Elliott. They have a reputation for being relentless.
They do, and their involvement is like a structural buffer for investors. It dramatically increases the odds that management will execute this turnaround with the necessary urgency. They are the ones demanding that 100 basis points of margin improvement.
And if management doesn't deliver, does Elliott then push for something more radical?
That's the playbook. If the margin plan stalls, the pressure from them to pursue things like divestitures or even a spin-off, say, of Quaker Oats goes way up.
So the activist turns that execution risk into a potential upside catalyst.
It's a fascinating dynamic. It really is.
So what should we be watching for in the next, say, 3 months? What are the near-term catalysts?
The main thing is the next quarterly earnings report. Investors are listening very closely to any commentary on the 2025 outlook. They want to hear that those productivity savings are on track.
And what about the bigger picture, the macro environment?
The macro backdrop is actually pretty supportive. Potential rate cuts usually help defensive consumer staples. And if market uncertainty kicks up, money flows into high-yield, low-volatility names like this one.
So to wrap this all up, what's the elevator pitch for PepsiCo today?
It's a compelling multi-year story. Think 18 to 36 months out. You get that defensive income, the nearly 4% yield, combined with a very clear roadmap for accelerated growth starting in 2026.
All while being watched by an activist who will hold their feet to the fire?
Exactly. You have a plan and you have accountability. That blend of income, growth potential, and structural accountability is powerful.
So the final question for investors to think about.
It is. Given those explicit 2026 targets and the activist involvement, the question you have to ask is whether the current price fully reflects the high probability that management has to deliver on that 100 basis points of margin improvement. If they do, the stock should re-rate higher.
If you enjoyed this analysis, make sure you hit that subscribe button, like this video, and drop a comment below letting us know what stock we should dive into next time. We'll be back soon with another session of Smart Wealth with Joshua.